members are in attendance. Let's move forward with the Pledge of Allegiance. Lauren, would you like to lead us?
My honor, thank you. I pledge allegiance.
Sorry, can you give me a second to pull up the flag? Okay, and I'll share screen.
Let's begin. I pledge allegiance to the flag of the United States of America and for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you.
Hello, everyone.
Good morning.
Morning.
Okay, we get started.
So I got the agenda. Okay, here it is.
Okay, moving forward with approval of agenda. Do we have okay, second, the agenda is approved. Approval of minutes. Yeah, do I have a motion? Okay, I'll second that. The minutes are approved. Moving on to public forum. If there are interested members of the public that would like to provide comments on items that are not on the agenda at this time, please let it be known. Your remarks will be limited to 3 minutes. Seeing as there are none, we will move forward with the business at hand.
Great.
Onto the business item. Staff, you can take it from here.
Yes, thank you, Councilmember Fan. And I just want, Debbie is still in the attendee waiting to be promoted.
I promoted her 3 times already.
Okay, maybe Ron, if you could take a look at that, please.
Yeah, no, she is on.
Okay. Okay, great. So good morning, Council Members Fan and Councilmember Chua. We're really happy to be here with you this morning to continue our discussion related to the Turing CSCDA project proposal. Just wanted to note that Debbie Kern from KMA will begin by providing some follow-up information as requested by the subcommittee, and also review the conclusion as well as preliminary recommendations. We did not get a chance to discuss those in detail at the last meeting as we ran out of time. So we'll spend a little bit of time on that. And if the subcommittee wishes, we could break then for questions. We'll follow up with the presentation from the project team. So John Pencower from CSCDA will be presenting information as well requested by the subcommittee at the last meeting. I just did want to note that John will also be presenting some information regarding affordability and capital investment that is amended from the last time around. It's fresh off the press, so we have not really had a chance to review the information. We may have some follow-up after today. And then again, we have an hour and a half, so we're hoping that most of the time can really be spent allowing the subcommittee to ask us questions. I know we took a lot of time last time just presenting the information. So with that, I'll turn it over to Debbie Kern from KMA.
Good morning. Nice to be here again today. Let's see. Oh, here's our PowerPoint. Thank you very much, Sharon. Okay, next slide. Next slide, we can go to this. So we just wanted to first go over the responses to questions that were raised by Councilmember Chua. Next slide. The first was she wanted an annual statement, I believe, of the abated property tax revenues over the 30-year term. And so this provides that. And it's really, you can see for the city's abatement goes from $381,000 a year up through year 30, it's $676,000 a year. And if you look at the cumulative over a 30-year term and look at that in current 2021 dollars, it's approximately $9.7 million of cumulative property taxes that will be abated. And for all taxing entities, the amount of property tax abatement goes from $2.3 million a year up to about $4.1 million, with a cumulative of about $59 million in current dollars. Next slide. Now this is, she also asked for an annual statement, a projection of what the gross sales proceeds would be, starting with the first year in which you could have a sale, which would be year 15, through the bond term. And so there are multiple slides that go through this, and I'm not sure, it just will take a lot of time to go through them. As you can see, what this shows in this first slide, that in year 15, for example, you have gross sales proceeds of $257 million. After debt would be retired, you would have proceeds of about $33.7 million. After you recover the property tax abatement, the net proceeds to the city would be approximately $33 million. So that would be, I'm sorry, that would be the, let's see, net proceeds would be $93 million after the city received the net proceeds. So, and then if you were to look at that in terms of, we're just flipping to different slides now. So I can't keep up with it. So I'm happy to walk through that, but I also just have a summary then of a table that just summarize it. So if you go forward, Sharon. Next slide.
This is the 2%. Okay.
Pardon me?
No, so this is the 2%.
Yeah, this is the 2%. And it just shows that, well, we're now in year 20 here on the 2%. And it's really, it's really showing that you could, that Milpitas could be recover its property tax abatement starting, I think, in year 20. And so really a sale before then would not be, would not generate positive returns to Milpitas. And then there isn't sufficient proceeds to fully offset all the abatement of property taxes that all of the taxing entities have paid until further on. Next slide. Next slide. One more slide. So this is just a summary in year 15 and just what I mentioned before. Under the Waterford projection, in which you have a 3% annual growth in rental income, but with a change that KMA has used a 5% cap rate, you can see that the net returns to the city would be approximately $17.4 million in year 15 if there was a sale in year 15, but there wouldn't be sufficient proceeds to reimburse all the taxing entities. With the less aggressive projection of a 2% annual growth in rental income, and then also a payment for capital improvements in year 30 of about $10 million in current dollars. As you can see here, in year 15, well, we don't have that in year 15. So it's without that, without the capital replacement in year 15. So it's just 2% growth projection, that there isn't sufficient gross proceeds to cover debt. So it's really not feasible to sell it in year 15 under a less aggressive assumption regarding rent growth. Next slide. And then this is looking at year 15 and under the Waterford growth projection of 3%. And I just wanted to, reiterate that 3%, it will be difficult to achieve that unless you have a lot of new tenants. So if it was just existing tenants that have that rent reduction, that they're subject to the 4% cap or the cap based upon the increase in the AMI, that it would be difficult to achieve that 3%. But with turnover, it would be with those new tenants that then you can raise the rents up to the CSCDA limits for moderate, then that's how you would achieve this projection, which they've underwritten the project with. That shows that under that projection, the net to return to the city in 2021 dollars in year 30 would be $127 million. And that's after the recovery of the abatement of property taxes. With the less aggressive projection with 2% annual growth and then the capital replacement in year 30, we're estimating the net returns to the city would be $24 million in 2021 dollars. Okay, next slide. So now just to go into our findings and recommendations, next slide. With respect to affordability, as I mentioned before, rents would be capped at moderate income levels. So that it's a moderate income program. And rents paid by existing income eligible tenants would decrease 10% on average, which is approximately $323 a month currently. But even with these reductions, the rental rates would exceed the average rental rates, market rental rates in Milpitas. So while they would be moderate income rents, they would exceed the average market rents in Milpitas. Now, the maximum permitted rental rates under the CSCDA program for moderate income, it's important to note that it actually exceeds the current touring rates by approximately $900 per month. And these were the rents that could potentially be charged to new tenants as units turn over, if the project needs that in order to pay debt service or be financially feasible. So it's our finding that the primary benefits are limited to existing income eligible tenants, because the rents on turnover tenants, on new tenants, there will be pressure to raise those rents for feasibility if the AMI doesn't increase at 3% per year. And the projected performance of the project and the ability to service debt, it relies on that underwriting assumption of an average rate of increase of rents of 3% per year. And so if you have years in which the AMI is flat and you have a lot of existing tenants, you're not going to be able to achieve that 3% per year. And then the last finding is that that the project, because the deed restrictions are for 30 years, there is no RENA credit to the city. Next slide. The financial feasibility, the key findings are that over a 30-year period, the city would forego about $15.4 million of tax revenue. Repayment to the city of that foregone revenue is contingent on the property's performance, and that you would get that through sales proceeds. That's how you recover your investment. A sale in year 15 is probably not feasible if rents grow at 2% a year. But net proceeds to the city with a sale in year 30 are yet estimated to range from $24 million to $127 million, depending upon rent growth. With the way the project is structured, the sponsors are not required to invest any equity into the project, and the bulk of their compensation is from bond proceeds, so it's upfront as opposed to being contingent on performance of the project. And based upon the property report, condition report, and looking at the annual reserves that are being funded for capital replacement, it does not appear to us that there is sufficient reserves to meet the project's needs throughout the 35 projected regulatory period, including the cash flow contributions too. Next slide. And so with respect to our recommendations, we recommend that the rent reductions should be set at levels that are below market rate levels in Milpitas, so that the project truly delivers enhanced affordability. Remember, the proposed reductions still yield rents that are higher than market rate. We recommend that the rent restrictions conform to the HCD income and rent formulas, which would provide for deeper affordability. We recommend that the cash flow and reserves be sized to cover anticipated capital improvement costs over the entire bond term. And that to ensure affordability benefits, that the performance of the project should be underwritten with annual rent increases of less than 3%, because that's what affordable rents are typically go up. Often many years they're flat. So it would provide more coverage if the underwriting was at less than 3%. We recommend that the underwriting assumptions be reviewed by the city's financial advisor to see if this is a program that they would recommend that the city participate in. It's our understanding, based upon past transactions, that the bonds do not typically receive an investment grade by the rating agencies. And so that is something that should be reviewed by the city's financial advisor. We believe that any refinancing the project debt should be subject to the city's approval, and that there's a bunch of reporting recommendations that we would like for the project to have to report to the city, so that the city can be assured that the project is being properly managed. And I think that's it. Sharon, you want to talk about next steps?
Yeah, I can.
Srini,
I can go ahead and just briefly talk about the next steps before we break. So we're meeting again today. This is our second discussion at the subcommittee about this topic. We are scheduled to go to the city council meeting on September 21st. And based on input that we received today, as well as some of the additional information that the project team has put together, we'll have a report to council. This is again an informational discussion. We're not planning to. This is a complex topic. This is the first time the council will be hearing about it, the full council, and so we want to make sure there's enough time for them to understand the topic. We're not bringing it forward for action. We are tentatively looking at a date in October, depending on council direction, to bring it back for action. And so I'll defer to the subcommittee at this point. If you'd like to break and ask KMA questions on the presentation, or move to the project team's presentation.
Councilmember Chua, do you have follow-up questions you'd like to?
Thank you, Councilmember Fan. Okay, please go ahead and have the applicant.
Sure. Okay. Thank you.
Thank you.
Let's proceed.
And Sharon, are you sharing your screen?
yeah,
The
I
presentation.
am.
Thank
Yes,
you.
I'm pulling theirs up right now. Okay.
Great.
John?
Hey, well, good morning, council members and staff. John Penkower, Managing Director with CSCDA again. We appreciate you making time available again on such short notice to continue the discussion about the program and the project. I'm going to go through these pretty quickly and then remain available for any questions. Before I do that, I'll give you a broad update on the program itself. So since we last talked, we priced bonds for a project in Fairfield, California last week. And then yesterday for two successful bond sales for two projects in the city of Orange. Interest rates have gone up a little bit, but they remain stable and allow projects to continue moving forward under the program. So we're very pleased by that. Again, there is a bit of a time of the essence component to this program, given that we don't have other funding sources and we are beholden to the interest rate environment. These projects will bring the entire program north of 4,000 units throughout the state since last year, where rents are being reduced for both low and middle income residents. Next slide. So what we did here is put together some information in response to questions from yourselves at our meeting last week. So I'm going to run through them. Feel free to interrupt me at any point. There was a question about insurance. So every property in the program is required to maintain insurance that complies with our program requirements. There's a master insurance schedule. CSCDA has an independent insurance advisor that sets forth those requirements. The city can be named as an additional insured party under all of the respective policies. We recommend that. It's probably the greatest additional protection for the city if they were interested for, frivolous tort claims or otherwise were named in some type of lawsuit. There was a question about bond insurance, and we don't see bond insurance. CSDA, we issue bonds for large hospitals, universities, housing projects. The bond insurance market doesn't really exist that much, or the costs are so great that they don't really make sense for just about any bond insurance, or excuse me, any bond issuance. I haven't seen bond insurance on an affordable housing project in probably a decade. There was a question about tenant relocation. So there's no separate insurance that we're aware of or that we've seen for affordable housing projects that would be separately obtained. So that would not be part of this insurance package, but that's no different than any other housing project that we would be participating in, or rather would exist elsewhere throughout the state. Next slide. So there was a request to see if the affordability could be deepened for this project. The typical breakdown is generally a third of the units reserved for low income. That's your 60 to 80% AMI, a third at 100 or below, and then a third at 120 and below. Project team spent the last week underwriting the project, stressing the model, working with the underwriting team and the underwriters. And they are able to increase the amount of units at the low income range to 40% of the project. So getting additional units in Turing for those at the low income level. And so you'll see there 40% below 80 AMI, 20% in the moderate below 100% AMI, and then another 40% below 120% AMI. The chart you've seen before, that's just demonstrating the rental savings. So you'll see, for instance, at a 2-bedroom apartment, anywhere from $300 to $400 a month savings for those residents. Next slide, please. Okay, capital improvements. So there's been some discussion. Debbie had some additional comments about that today. So what this slide here illustrates is the CapEx contributions under this structure, under this program, compared to what you would see with any other type of typical market rate commercial financing, where you don't typically have any reserves funded. In this case, there are reserves that are funded from bond proceeds at closing, and then annual contributions going from $300 up to $1,000 a unit. That would well exceed what you would typically find for market rate properties. So you're seeing there over the life of the project, more than $16 million in reserve money put aside for capital improvements. I'm going to talk about rent growth on the next slide. But in addition to the CapEx reserves, this program requires additional reserves for debt service, coverage, extraordinary expenses, and that you see that there at the bottom there of this slide, more than $12 million. This is what gives comfort to investors. These are large institutional mutual funds, insurance companies that are buying these bonds. I mentioned that we had bond sales last week and yesterday. We're still 5 times oversubscribed So there's still a very robust market for these types of projects. Next slide, please. Okay, so rent growth. There's obviously many different ways to look at rent growth. You can look at a portion of a city, you can look at the entire city. What we did is we looked at Santa Clara County here. And we took going back to 2006 and then projections going forward the next couple of years. This is from CoStar. So we're coming out closer to 4% in historical and projected future rent growth. This does not carve out Class A properties, which would typically have higher rent growth. I think what's also important here is even looking at historical rent growth as it relates to Milpitas, that's not taking into consideration the last few years where you have seen in your city really robust building and growth of newer Class A type properties. So when you factor that in here, there's a likelihood of seeing even stronger rent growth. That's in addition to the continued housing crisis and lack of housing stock, which would also lead to higher rents in the future there. Next slide, please. So this is the rental savings. In our last meeting, there was discussion about growth of market rate versus restricted rents. I think Debbie had mentioned in part of her analysis looking them at the same growth rate. If they really were at the same growth rate, I think we would have challenges selling properties anywhere throughout this program. We anticipate that market rent growth would grow higher than faster than those at restricted rents. And so what this illustrates there is a modest difference between market rate rent growth and middle income under this middle income program of 3 to 3.5%. What you come out with is aggregate rental savings north of $174 million to the residents that would be occupying this building. So that's pretty meaningful, and that's compared against the city's aggregate tax loss of $11 million. So you've got a roughly 15 times return in affordability for the city's residents. The bottom of this slide, the reversion analysis. So there was reference to $28 million being needed at year 30 or before the property could be sold. And so we look at that a little bit differently. That level of capital expenditure at that time would likely be in connection with a market rate sale. We have not talked to any city that envisioned removing the affordability from these projects in the future. Again, that is at the city's discretion. But we look differently at that level of capital needs at that time. Generally, you would see that when the property is going to be essentially turned into a value add project, where that current owner is going to put a lot of money in there because they're going to sell it, and that buyer is going to anticipate raising rents significantly. In all the cities that have participated in this program, at least in the short term, again, you don't know what a council is going to do in 30 years from now, but they would want to keep the affordability and perhaps even deepen the affordability. Next slide, please. This is the reversion analysis that we looked at before. One comment on cap rate. Again, we can slice this and dice this many different ways. We can put a 3% cap rate. KMA used a 5% cap rate. We don't envision cap rates returning anywhere near 5%. They're in the 3% range right now. It's going to take us decades to build the housing that we need throughout California. So we would be pretty shocked if we started seeing 5% cap rates. So we've used a 4% rate here in this reversion analysis. This shows you that once the debt is repaid, there could be $500 million in surplus revenue. Again, we could look at this a lot of different ways. Maybe it's not 500 million and it's a 45x return on investment for the city. Either way, it's anticipated to be a large number. Next slide. Other taxing agencies, I think there was some discussion about the school districts. There's two different types of school districts, basic aid districts and local control funding formula school districts. Milpitas is the latter, so it's not impacted by one or more properties coming off the tax roll within the city. They receive funds through state apportionment. Other school districts have expressed comfort and been excited about this program for a couple of reasons. First, the city can not only make that school district whole, but they could share pro rata in the profits down the road. But more importantly, you're enabling more families to live in this community and send their kids to the school district. Enrollment benefits the school district, but you're also allowing families, their children, to be able to go to better schools. Next slide, which I think may be the last one. So this is just a reminder on what is being requested from the city. The project team is requesting that the item be considered at the September 21st meeting. Sounds like you may take that in two steps. If it's possible to include a resolution at that meeting, that would save the council from having to go back. Obviously, if there's more discussion, we understand that it could go back at another meeting, but this doesn't require a public hearing. So if the resolution could be included as one option on September 21st, I know the project team would appreciate that. The city is already a member of CSCDA. What council is being asked to do is adopt the resolution that opting into this program, which is no different than our infrastructure programs and other tax credit programs that we offer, and to consent to the public benefit agreement. And that simply confers all of the future financial interests in the property, all disposition rights in that property back to the city, but doesn't require any other responsibilities on behalf of the city. And I think that's it. So again,
John,
greatly appreciate your time. Yes.
But John Penkhurst, this is John Drackman. I'm Sean Rawson's partner with Waterford. You mind if I add, I think, one more important point on the school district point?
Sure.
I think one thing, we've found as of recently with our existing projects with CSCDA is that we've reached out to various school districts within the cities where we've acquired these assets, and we've started to build really strong relationships with them, because one of the benefits that we have with this program is their teachers and their faculty and staff being our tenants at the project. And that's one big thing that we've heard from a number of the school districts, local community colleges, Cal State schools, is that they're having issues with their employees and their teachers in terms of finding local housing that's affordable. And so I think that's another benefit that we've heard that I think is important to note, that one of the first steps we would do in this program is reach out to the Milpitas Unified School District, make them aware of the program, make sure they have all the information on it, and make sure that they know for their teachers and their faculty and their staff that this is an option for more affordable housing in it, because this program really targets that essential worker. That's all.
So with that, again, we greatly appreciate the extensive time that your staff has put into the evaluation of this program, and to both council members for your time today, and remain available for any additional questions.
Thank you. I'll defer to my colleague right now if there are follow-up questions. I'm sure there's some input there.
Thank you, Councilmember Fan. I have a question to John. Can you detail out? It just so happened that KMA came up with a need of 28 million at the end of 30 years, and you said you have a reserve of 16 million and 12 million. Can you detail out again, how did you get those figures?
So the initial contribution.
You have it on your slide. You can go back to that slide.
I don't have control of the slides, if staff can.
This is, I think, third to the last one. IT.
Yeah, I put up the slide, so John, let me know.
Not that one.
It's actually the fourth slide.
The one before this, I think.
That's
This one. This one.
Right. Okay. So the reserves are funded in different ways. At the bond closing from bond proceeds, there's initial lump sum of money that is put into the capital expenditure reserve, and that is based upon the property condition report, looking out 12 years. In addition to that, there are annual contributions per unit in the property that start at $300 a unit and then rise rapidly to, I believe, $700 and to $1,000 a unit. And so that's putting aside. So the project is not waiting until the end of 15 or 30 years to make improvements along the way. It doesn't have shareholders. It doesn't have equity investors. So it has dollars coming in from cash flow that can also make contributions. It can also pay for capital expenditures. The reserves below, those are not for any type of capital improvements. That is just for the protection of the property and to protect bondholders. And you have an entire year of debt service. It's more than $8 million. You have a coverage reserve. There's a comment in one of the recommendations that the sponsors are not contributing equity. They're not permitted to contribute equity under this structure, or it would violate the private use restrictions. So this has been set by investors, and they invest in these properties because they have comfort in the reserve structure. Again, 5 times oversubscribed, 10 times oversubscribed. This is not a novel program at this point, or a novel type of financing structure. It's quite mature.
John, I'd just like to, one quick point too to add to this is that our initial 12-year CapEx budget was just over $3 million. And my belief is when we first presented this to the city, that was what that reserve fund was. We have increased that based on the feedback to $5 million, just to have a little bit extra reserves there on that initial capital expense fund. So that, I think, is an important point to note, that we're only showing over the next 12 years an inflated value of just over $3 million of CapEx that the project needs.
Okay. And can I call on Debbie, please?
Yes.
Hi, Debbie. Thank you for being here this morning. Can you give us feedback on these figures for us?
Sure. So we have, looked at the combination of the reserve, the upfront reserve from the bond proceeds, which the information we had was 3.1 million, not the 5, which they've increased recently. And then the annual contributions from the cash flow of first $300 per unit per year for 9 years, escalated at 3%. And then in the 10th year, it goes up to $700 per unit per year. If you look at the property report, the property condition report, that then was used to come up with a $3.1 million reserve, and you look at what those were, what the needs were over that 12-year period, and you extrapolated that out, there would not be sufficient revenue to fund the needed improvements over the whole 34-year term. And the capital condition report did not include items that you would expect in a property as it ages. It didn't include, upgrading landscaping improvements, paving improvements, replacing doors, or any of the interior windows, any of those things that you would have to do typically over a 30-year period. Not to mention a roof, any kind of other capital replacement that was not funded or as part of that property condition report. So I believe that the property condition report should be undertaken that would identify what the needs are for this property over the bond term, not just 12 years. And I'm not suggesting that that all be capitalized. I'm just saying that a funding program should be in place between the upfront bond proceeds as well as the annual contributions that would be sufficient to cover the property's needs over that bond term. And you know, this is a different project. When they're talking about market rate projects wouldn't have that same level, but you know what, market rate projects generate significant cash flow that can be used to fund these improvements. And regarding the disposition of the property at the end of the bond term, that's fully at the discretion of a future council in 30 years down the road. And whether it be turned over as affordable housing or it's sold on the open market for market rate, the city wants to ensure that the asset is in good condition. And so we're not saying what the number should be. I'm suggesting that the property condition report by a third party be prepared that identifies what the likely needs are over this bond term so that the property will be returned in a marketable condition.
Thank you. Thank you. Thank you both. My next question is to John. It appears that current and future rents will be higher than the AMI. What's your rationale on that one?
The anticipated rent will not be higher than, I'm sorry, can you repeat your question?
It's my assumption that your rents will be higher than the AMI in Milpitas.
The rents will not be. So are you referring to citywide average rents?
Yes, I mean Milpitas wide. That's based on your presentation from before, and I didn't see it this time. Can you expound on that? Can you touch on that one for me, please?
The question is whether rent and touring, even restricted, would be higher than a 1-bedroom unit throughout the entire city. This comes up in a lot of other cities. And what you're doing there is you're including, B and C, category properties throughout the city. It's not a true apples to apples comparison. And I think what other cities have realized is that, folks that are qualifying for this, they want to be able to live in nicer, newer properties throughout the city. So by including every, class B and C property, this is often referred to naturally occurring affordable housing. These are the same properties that are being purchased, gobbled up all throughout the state by large investors who are going to put money into them, and they're no longer going to be naturally occurring.
I got you. You're saying because you're class A, that's why you have the option to make the rents a little higher than normal. I got it. Okay, you mentioned that there was a desire for us as a city to maybe increase your capital investment to the project. But you're saying that it's prohibited in terms of the terms of this project. Where is that in the bigger scheme of things? Where is it that says you cannot reinvest more capital? And who set that up?
So thank you for the question, Council Member. I think you're referring to my comment about equity or private sources of money being contributed to the property. So we are issuing governmental bonds. It's no different than if the city was issuing bonds for a project within Milpitas. You could not have private interests. You couldn't have shareholders or equity participants. Or it would violate the tax status of the bonds. And so we can't have sponsor money or equity money go into, we don't have any other funding sources. Public money, yes, could be contributed. This is the model that we're using today Is it perfect? No, we'd love to see improvements. We'd love to see more public sources of money get contributed, perhaps land grants, ground leased land, other affordable housing funds to perhaps deepen the affordability or provide other benefits. So public money is okay. Private money is not consistent with the program.
Do we have any that is a combination, any projects that is a combination using, is there an option, a bond option that would require or be open to private money funding that you know?
For this program, no, but for traditional affordable housing, yes. So affordable housing, low-income properties are traditionally financed with tax credits, low-income housing tax credits, and 4% bonds. And CSCDA has been the issuer for 900 of these projects. They require an allocation from the state of California, which is heavily oversubscribed right now. For instance, there were 30 projects in the Bay Area in the last round, and only 2 of them received bond allocation. So cities like Milpitas, your neighbor San Jose, it's a terrible situation there, and elsewhere, they have projects entitled, ready to go, and they cannot get their funding sources. Under that program, you can have a private owner, a for-profit or a nonprofit. However, even under that structure, they're not putting in any true private equity dollars. They will remain the owner of that asset. And I know there's a discussion about, front-end compensation. In traditional affordable housing, you have private developers. They don't put $1 of their own money into the projects. They receive pretty significant developer fees. But in year 15, they also cash out the tax credit partner, and they receive this massive windfall of accrued equity. Under this program, that doesn't exist. That all goes back to the city.
Okay. Thank you. Seth? Hello, hi. I know I gave you an assignment last time. So can I get your feedback now, please?
Yeah, you had asked council member about the insurance and the bond insurance, potential replacement insurance. And I think that the CSCDA team reported back on that as part of their presentation.
Okay, I got that. Is that in line with what you were going to say?
The question was what they're offering. If the city wanted to evaluate, but here the city is going to have no ownership, no involvement with the project, no oversight, no involvement. The city is not in any way an owner, or even have an equity kind of interest, even a regulatory interest, as you would traditionally see in your projects, your affordable housing projects. Typically, the city would have a regulatory agreement where they would be named, they would have a seat at the table, they would have some involvement. Here, there's none of that.
Don't you feel that, as a legal expert, having something like this in the city and no oversight function, wouldn't that be a risk? Wouldn't that be risky for our city to be in that situation?
The way that this project is structured is that the public benefit agreement appears, it gives you a future option right to purchase, but the performance of the project is completely out of your hands. Debbie had mentioned some future reporting. Reporting is nice, but if the project isn't hitting and frankly, the project doesn't really have performance standards as I see it. There are aspirational numbers to hit, but in terms of performance standards or a seat at the table or the ability for you to have any local control, I don't see any of that in the current deal structure. So in a typical affordable housing deal, you would be involved. You'd have a regulatory agreement. If something went wrong with the project, you would have a seat at the table. You might be subordinate to other financing. Here, it's the CSCDA entity that would take the place. So there's no local control here, no responsibility, no administrative oversight, no fees to you, nothing, no involvement.
Okay, thank you so much. I think that's it for me, and I give it back to Chair Councilmember Fan. Thank you all.
Great. Thank you so much, everybody. Really appreciate your efforts on this. I know, this was something that has been in the works for quite some time. I'm proud of where we've ended up. Really appreciate the project applicants for your spirit of collaboration with the city and meeting us in the middle. I think that it is very commendable that you have opted to deepen the affordability levels up to 40%. That is going above and beyond the requirements, and I honestly see this as a first of several projects down the road. I'm sure there's a lot of interest from other folks, and once people see the benefits of this, I'm sure we can tweak newer opportunities for further affordability. At the end of the day, Milpitas as a city has never really been in the business of property management. But we are in the business of creating opportunities, of trying to get folks housed, of trying to accommodate for the housing affordability crisis. And to that end, though, I see this as a long-term investment. While we might not see the benefits immediately, or the benefits might not, be to the extent that we would like it to be, the long-term benefit is that we have the property, we own the property, and we can choose what to do from there. So I see that as a window of opportunity for further affordability, because at that point the city can, choose to do what we want, and that's where I see the real benefits are. And obviously, because that is something that is down the road towards the end of this agreement, it's not really being discussed. But I really want to highlight that, because we can do so much from there. It can be the sort of opposite situation as Sunny Hills, because we would actually own the property. We talk about that area and the issues that we're going through with the lack of control of it, because we don't actually own it. Here we actually would after the timeline. So that is a huge value proposition. I know it was brought up that the applicants aren't required to invest the equity. Obviously, it was mentioned that they can't legally do that. But also, I want to point out that they have already taken on the risk, because the property is already built. That's not something that is easy to do. If we were to say, let's start a middle income housing program from scratch. The city hasn't, like I said, been in the business of property management. And of course, it's not really in the business of residential development either. The private sector and our stakeholders are. So that risk that has occurred, I would say, is the investment, additional investment, on top of the project at hand. So I see a lot of value here, and I hope that we will be able to make this a successful project for as a model for the rest of the Bay Area to follow, because folks in the state, other folks in the state are already doing it. And this is our chance to really do something good. Additionally, I want to point out, I want to commend the project team for increasing the reserve fund from 3 million to 5 million. That's something that we discussed about prior, about our concern as to having the reserves necessary to take on the debt, and that goes a long way towards that 3 million to 5 million. That's a huge increase. I thought it was good to know that the school district funds would be covered through the state. But at the end of the day, even if it wasn't, what you get here is an opportunity to house workers. It's worker housing, in many lenses, and that's something that the school district needs for their teachers, for their classified employees. So that in itself is another incentive. Certainly incentive for a lot of other agencies. So I really don't see the need for us to go beyond and reimburse the taxing agencies, because when it comes down to the housing affordability crisis, a lot of the time our resources we don't have enough resources to actually create the housing, because the taxing agencies take on a lot of that revenue. So this is really about equity here. But that in itself is a completely different issue, a systemic issue. I think what we have here is a proposal with a long time stakeholder, a partner to the city, that has demonstrated a lot of good faith. I'm hopeful that we'll be able to streamline other projects in the future, should this one be a success. And to that end, if staff can pull up the slide on the next steps.
Councilmember Fan,
Yes.
I'm going to be brief, and
Sure.
You said your piece. And there are concerns. As far as my concerns are, this project is addressing Class A affordability. Well, the city is looking for B and Cs. That's one.
Yeah, and
I don't need an answer. I'm just saying my opinion.
Sure. Please continue.
In order for an investor to be fully committed, or they have the way it's structured is they The investors are getting their money upfront, 5 million and 3 million. Yeah, and that's it. No more private funding after that. That's a concern. The calculations on the way the bond will be paid, it's very generous. If you compare it with the KMA's calculation and the developer's calculation, there is a big gap. That's a concern. I mean, there's also a concern that for local control, oversight, we don't have that. The way it's structured, the city does not have control over this project. We don't have a say whether we can't do evaluation of the performance of the project during the course of 30 years or 34 years when it's paid. I see that the main thing for you, I mean, I shouldn't say that, but the main thing is ownership of the property after 30 years. But there is a question. What type of property are you getting at the end of the bond period? Were you going to spend more to bring it up to par? Those are my concerns.
Sure.
So that's it. So
Thank you. I certainly would like for the applicants to address some of those concerns. But before that, I do want to note that just like any other market rate project, cash flow is always on the table as an option in terms of improving the property and any required additional improvements. So that's always on the table, and I do want to make a note of that. See what else was brought up. The control of it. Yeah, I'd love to hear more from the team on that aspect. I'm sure they do have a response there. So why don't we let the applicants a chance to address these concerns, and if they're unable to provide that at this meeting, I'm sure they will address it at the council meeting. So please, staff, if you can help with the presentation. If
Yeah. So this is John Drackman with Waterford Anthony. I'm happy to answer and address those questions. These are great questions. First, I think, we responded to the comments from the presentation here. Let me make sure, open it up. I'm looking at my slides. Let me make sure. Everyone can still see me okay? Perfect. We've responded to the question on capital expenditures. So when we initially presented this project to the city, as mentioned, we got a CapEx report done, a property condition report that showed 12 years of inflated, inflation adjusted numbers at about 3.1 million. We've increased our reserves to $5 million to help have additional reserves. At the same time, for years 10 through 35, or call it 33 of the bond hold period, to the bonds are fully paid off, we increased our ongoing reserve from $700 a unit to $1,000 a unit, which is probably 3 times as much as what you normally see on a market rate project. So I think those 2 ways have addressed it. I think something else that's really important to notice is that we have ongoing operating expenses at the asset. And as a part of those ongoing operating expenses at the asset, we have 2 sort of ongoing capital expenses that we have budgeted in, which are both turnover and repairs and maintenance. This go to more sort of the normal repairs and maintenance and the normal turnover costs that you're going to see at an asset. Some of these things would be replacing doors, replacing carpets, doing new appliances, things of this nature that normally happen. over the course of the bond period, we have about almost $15 million in line items that are coming off cash flow that we budgeted as well. So I think we've adequately, or more than adequately, addressed the concerns about maintaining the asset. This is a question we get from our bondholders because they're very concerned about maintaining the cash flow at the asset. And one of the things that we can do to ensure that we maintain cash flow is have a nice, clean asset that is leasable and tenants want to live in. This is important to Waterford. We, all of our projects, we take great pride in making sure that they are, everything is maintained. Landscaping, we have costs within our contract services to maintain and upgrade landscaping through the cost of this. That's in our normal operating expense budget. So I would say from our perspective, we feel that we've tried to increase our ongoing reserves up front and on a go-forward basis, and feel that we have more than enough to maintain this property in a Class A manner. The second point that I'd like to make in regarding ongoing capital is Waterford, we're giving a B-piece bond. So we're going to be given a subordinate bond in this transaction. That money is not paid up front. We're not paid that lump sum until all the bonds are fully paid off. We are given an interest rate on those bonds. And if for some reason we saw something with the asset where, for whatever reason, that would be potentially impaired, Waterford would step in because of that ongoing interest and can contribute money in an additional subordinated bond. Bondholders want to ensure that there is somebody who has a vested interest in the stake, and that would really be both my business partner, Sean, who you've met, and myself, because we'd have that ongoing B bond that we would want to protect. And so, we have ability to maintain, and if we have to, protect that B bond interest. That is something that the city should take great comfort in. And it is something that our bondholders take great comfort in, because a lot of these questions that you have is also questions that we get from our bondholders as well. I think something that we like to state, and I think that is so unique in this program is, our bondholders are a unique form of capital, meaning they are not getting any of the equity upside in this transaction. They are investing in these bonds to get a rate of return and get paid off. And the uniqueness of this is that giving the city all the equity upside in this. You can go through the numbers and decide on cap rates and decide on what it is. What I would ask everybody on this call to think about is, where were home prices and apartment values 30 years ago in the city of Milpitas, and where are they today? And if you think about where real estate prices have gone over the last 30 years in California and where they're projected to go, I think in our opinion, this could be a significant benefit to the city and cannot be overstated. And you can think about it from very granular monetary terms. But I think if you think about where home prices and apartment prices were 30 years ago in the city of Milpitas, where they are today, I don't think there's any question that 30 years from now, they will be markedly higher. And as we pay down these bonds, I think that our strong belief would be that equity upside to the city is substantial and is something that is extremely unique in this program. The last point I'd like to make, and I think Anthony made it very well, is that the major benefit of this project too is, as soon as we close on these bonds, we immediately go in and start lowering rents. This is not something that you have to plan for 4 to 5 years to develop or do. This is something that's going to have significant rental savings. And if you think about the cities that have approved this program, the city, one of the reasons the city of Orange approved our program 3 weeks or 4 weeks ago was because of the success that we've had in the city of Anaheim. And the major things that we're seeing in the city of Anaheim is a greater rent discount that we're offering tenants than we projected, because market rate rents are increasing at their fastest rate in the history of the United States. And we feel that market rate rents are in this area in Northern California are going to increase very fast. For the first time ever, year over year, we've seen 10% rent growth across the United States in apartment rents. So this program allows you to restrict rents, and that's what we've seen in the city of Anaheim. And we're actually offering deeper affordability on our units than what we were projecting, because market rates have increased so heavily. So,
Councilmember Fan, I would like, if you will, I would like to hear from Debbie as your
of course.
remark, please, before we end this meeting. Debbie, you've heard all the questions and all the feedback, answers and information. Can you give us your summation, please?
My summation. Well, I think that the biggest issues with respect to this program is the level of affordability that will be generated, and that a lot of talk is about the amount that they're going to discount the rents to income eligible existing tenants. We don't know how many tenants those are because they haven't gone through the process of checking the incomes and who will be eligible for those discounts. That's one bucket of people. But as these units turn over, and as we talk about the increases in market rate rents, and when you look at the caps that are on the CSCDA program, those capped rents are high. And we looked at not only, there's talk about that we just compared it to all of the stock of units. I looked at units that were built since 2014. So they're new units too. And these rents are high relative to the rents that are generated by that subcomponent of the market in Milpitas. And so, and the allowable rents that's permitted to increase under the CSCDA is very high. It's not HCD levels. It's much higher than what the Turing's current rents are, $900 per month difference. They're higher than what the current rents are. So if there's big pressure in order to pay off the bonds, which there should be, I mean, in order to pay off these bonds, they have to have an average annual increase of 3% per year. So in years in which that AMI is flat and you have existing tenants, those rents on those existing tenants will not go up. But the only way they can make up for that difference is to increase the rental rates that are charged to turnover tenants. So those turnover rents are going to be high in order to make this project pencil over the long term and pay off the bonds. So I just think that in terms of on paper, yes, it's a moderate income program. Yes. In terms of the rental rates, are they going to be discounted a lot? They will be for existing income eligible tenants, but not on turnover. And so I think over time, there's going to be a lot of pressure on those turnover rents to increase, to offset the rents that are charged to the existing tenants that are not going to go up that much. They will be protected, but it will be the new tenants. So it's just it's a moderate income program, and I think that that's how you should look at it. And in a lot of years, those rents will be commensurate with market for many of the tenants. The tenants that stay there over a long period of time, they will definitely benefit from the program. And I think that over the long term, the city could receive quite a bit of net proceeds from the sale. It depends upon what happens with who occupies those units and the turnover and what the increase of those rents are. So that's it in a nutshell.
Thank you. Thank you so much.
Can I respond to that with one comment, Anthony?
Please go ahead.
I would say one thing to keep in mind within this program, as us acting as the project administrator, we have no major financial benefit of increasing rents more than what we're showing in the pro forma. The only entity that would really benefit for us increasing rents more or having to push rents more would be the city, because we pay the bonds off faster. Our really motivation is just to ensure that we pay the bonds off at this. What I always say about this program is, if you believe that prices of rents and prices are going to be flat or stable over the foreseeable future, this isn't as good of a program. But if you have a belief that rents are going to continue to rise, which we strongly believe, and you think there's going to be continued price appreciation of real estate in California, then we think this is an excellent program.
Okay, thank you all so much. And first of all, thank you, John, and your team. Thank you to Debbie as well. Thank you so much. Good feedback. And thank you to Seth, and of course our city team. They work on this really hard and they give their best effort on this. And also thank you for my co-council member, Anthony Fan, for bringing this over. And I think the next time we see this one is on informational presentation over at the council on the next council meeting this month, correct? I have another meeting, so I apologize. I have to leave in 5 minutes. So
Sure. We can wrap this up.
Yeah. Councilmember Fan, we do have members of the public that have raised
Yeah.
their virtual hands.
There's one public member, and do you want to limit to 3 minutes or less?
We'll limit it to 1 minute.
Okay. IT, can you pull up the counter?
Councilmember Fan, do you want to call on them? There's 2 members.
There's 2?
Yes, there's 2 members of the public.
Okay. Yeah, please. Who is it?
Oh, 1 member just disappeared. So we'll start with Urvish Kumar Mehta. If you can unmute him, IT.
Thank you very much. First of all, I wanted to thank the city manager, city staff, as well as the entire city council subcommittee with regards to the implementation of the city's subcommittee on the financial needs. It is more than important to evaluate that where City of Milpitas stands, and in terms of equity, bonds, as well as with the ongoing trends of the market, very important to understand to build the investment portfolio, as well as verify that where the financial needs are the most vital in terms of growing with the growing needs of a city, and as well as with the housing needs as well. It's not just about building the equity, bond indexes or the investment portfolio. It's more about that, how city can benefit from the existing finances and build the future finances based upon what is available. Also important to generate the reports quarterly and doing the audits. Thank you.
Jacqueline Romero has her hand raised.
Great.
Good afternoon. I unfortunately saw this on Facebook and jumped on and wasn't able to hear the whole meeting. So I want to apologize ahead of time for not knowing the whole story, but I would have liked to have some type. I mean, this is a big purchase for the city if this is going to happen, and it would be nice for the community to have an opportunity to hear what was going on and have it in the evening time so the residents can be involved in this conversation. I'm looking at the Yelp reviews for this organization, and it just seems a little bit concerning to me on some of the things that has been written here. I'm not sure if the city staff has looked at the Yelp reviews for this organization. I'm just looking forward to seeing more. The agenda item didn't say much, and the also the packet was just the insurance packet. There was no other information about this item that anybody could preview. So if you could kindly maybe send me some information, that would be greatly appreciated. Thank you so much for your time.
Okay. Thank you, everybody. I want to be respectful of Councilmember Chua's time. So,
Councilmember Fan,
yeah.
I just wanted to give information to say that
please,
this will be for Jackie, Ms. Romero's concern. This will be presented on the next council meeting for informational discussion. So please tune in. Thank you. Thank you, Councilmember Fan.
Absolutely. Thank you for mentioning that. I was gonna add that these subcommittee meetings are typically for the subcommittee. It is a public meeting and public is welcome to attend, but the information is largely for the subcommittee members. Whereas once the topic goes to council, the community is much in involved in that process. So I do welcome that opportunity in the future. Lastly, before we go, if we can pull up the slide for the next steps. It's with the dates.
Froze, yeah, it froze a little
Okay.
bit.
Great, wonderful. So, I think this is something that should just be adopted as best practice, just because of, we all know how long how long council meetings can go on, and sometimes it dragging further than needed. Sometimes items not getting back for a long time, but then sometimes we would want to take action, but we cannot because it's not agendized as so. So I think for items similar to this, including this one, the agenda should be agendized in a way that is broad enough that if action is directed, if enough information has been discussed and the deliberation merits it, then it should be phrased as and additional consideration and action, to leave that language in there specifically. And this is just something that we should do with all agenda items going forward. Certainly, I understand if we will need more time, and that's why we can always do additional meetings after that. But I do want to make it so that it's agendized broadly enough that we have that flexibility. And that's pretty much it for me. Thank you so much to my colleague. I really appreciate your genuine feedback. I want to make sure that the project team is able to address your concerns. We do want it to be a project that you are comfortable with. And if there are additional concerns, we want to make sure that we address that. And thank you to staff. Really, I can't thank you enough because this, we've made so much progress within just the last subcommittee meeting and this one. So much information has been brought forward that could not have been done without you. And thank you for the project applicant and the KMA representative. I look forward to hearing more at the next council meeting. Thanks everyone.
Thank
Thank
you
you,
all.
everyone. Really appreciate everyone's time.
Thank you.
Thank you.